Earnings guidance is a practice where a publicly traded company provides its shareholders and the broader market with estimates or projections of its expected future financial performance. This guidance typically includes forecasts for metrics such as revenues, earnings per share, EPS, and other key financial indicators. Earnings guidance can be in the form of quarterly or annual earnings forecasts and is meant to help investors and analysts make more informed decisions about buying, selling, or holding the company's stock. Earnings guidance is typically given in conference calls with investors and analysts and in press releases available to the public. In April 2013, the SEC stated that social media posts on sites such as Facebook and Twitter, now X, are just as good as news releases and company websites if the companies have told investors which social media outlets they intend to use. The Audit Committee plays a crucial role in overseeing and ensuring the integrity of a company's financial reporting, including earnings guidance. The responsibilities related to earnings guidance include: 1. Review and approval. The Audit Committee should review and, if necessary, approve any earnings guidance before it is released to the public. This review ensures that the guidance is consistent with the company's financial reporting policies and that it is based on reasonable assumptions. 2. Assessment of risk factors. The committee should assess the risk factors and uncertainties that may impact the accuracy of the guidance. 3. Oversight of internal controls. The committee should oversee the company's internal controls related to financial reporting, which includes the processes used to prepare earnings guidance. Strong internal controls can help prevent the release of inaccurate or misleading guidance. 4. Communication with external auditors. The Audit Committee should maintain open communication with the company's external auditors. This includes discussing the company's earnings guidance and any related issues or concerns. The Cheesecake Factory, a restaurant chain based in Calabasas, California, was involved in a securities enforcement action by the U.S. Securities and Exchange Commission, SEC, in 2020. The SEC alleged that the company had made misleading and false statements regarding its expected financial performance in its public releases of earnings guidance. The key details of the case are: misleading disclosures. The SEC alleged that the Cheesecake Factory made materially false and misleading statements in press releases in March and April 2020. These statements, made in the midst of the COVID-19 pandemic, included information about the company's expected financial performance, particularly regarding its first quarter 2020 results. Overly optimistic projections. The Cheesecake Factory had allegedly projected that its first quarter 2020 same-store sales would be only down 1% to 2%. However, these projections did not take into account the significant disruptions caused by the pandemic, including temporary restaurant closures and reduced customer traffic. In December 2020, the Cheesecake Factory settled the enforcement action with the SEC without admitting or denying the allegations. The company agreed to pay a $125,000 penalty and consented to a cease and desist order, which included refraining from future violations of certain securities laws. In summary, earnings guidance is a company's projection of its future financial performance, which is important for investors and analysts. The Cheesecake Factory case serves as an example of the consequences that can arise when a company provides misleading or false earnings guidance. The Audit Committee's responsibilities include reviewing and approving earnings guidance, assessing risk factors, overseeing internal controls, and communicating with external auditors to ensure the accuracy and transparency of such guidance.